Hello, everybody. Ed Yardeni here. I'm glad you could join me today. Today is May 16th, and like to start promptly at 11 a.m. Eastern Standard Time and try to do this all in half an hour. Interesting week, the past week for me. I'm not talking about the market. Did some marketing. Went out last week on Monday. I presented at the Money Show in Las Vegas. And I'm not a big fan of Las Vegas because I'm not a big fan of gambling. Maybe it's because I do enough during the day here with my forecasts and occasionally changing allocations in my portfolio. But from Vegas, I went on to California and met with accounts in Los Angeles and San Francisco, Pasadena, and the OC. They're all, like everybody else, they're kind of nervous about what's going on here. Everybody knows that you're not supposed to fight the Fed. And I guess what we're all learning here is don't fight the Fed when they're fighting a persistent, pernicious inflation problem here. But a lot of us have been through these kind of swoons before. And I think everybody kind of doubts it's going to be anything like 2008. I think if there's any similarity to previous bear markets, if that's what it turns out to be, as you know, last week on Thursday, we were pretty close to a bear market. We were down 18% for the S&P 500 from its January 3rd high. And then Friday, we had a nice little rally. It was Friday the 13th, and yet it was a good day for stock market bulls. But as of Friday, we were down about 16%. So it's a correction, but it's awfully close to a bear market. And if it's going to be a bear market, I think it's going to be more like 1987, where there was no recession. Earnings expectations continued to rise. And I'm talking about the earnings expectations of analysts. But we had a real sell-off in the market. So it was obviously PE-led sell-off, but it didn't last very long. The whole thing was all of 3 months, and most of that drop occurred just in one day. This time around, this one's been hanging around for longer. It's been more painful, clearly, more of a roller coaster to the downside than the upside, clearly. I was thinking that this year would be a volatile year, but it's been volatile to the downside more than I would have expected. But I guess benefit of hindsight is always 2020, and we've had ultra easy monetary policy since 2008, since the great financial crisis. There were attempts along the way for the Fed to normalize, but the stock market objected, and we had a few tapering tantrums, and there was not much of an inflation problem in the past. So when the stock market had a tapering tantrum, the Fed could accommodate us and ease off. Well, there's as I've said over and over again, the Fed put is kaput. There is no likelihood at all that the Fed will respond to weakness in the stock market by giving us some words of kindness and some easing. The Fed is clearly committed to bringing inflation down. At least that's the latest pivot. Under Fed Chair Powell, there has been a tendency to pivot and pivot fairly often. But just last week on Thursday, Powell gave an interview where he backed off on his soft landing notion. He didn't say that that's not still the goal of the Fed. The Fed still wants a soft landing, but he said he couldn't guarantee it, which kind of makes sense. But he said there's a lot of things that are out of the Fed's control. All the Fed can really do is control the demand side of the equation. And he said there's a lot of things going on the supply side that may very well lead to a recession. I think the reality is that if inflation doesn't come down and persists and remains quite troublesome, the fact of the matter is Powell might have to do a Volcker in some ways and raise interest rates to the point of causing a recession. Maybe not as severe as the one that Volcker created, but one that's bad enough to moderate inflation. So you can't take that scenario off the table. And Powell was sort of being forthright about saying that's a possibility. But he still, I think, would prefer to bring inflation down with the soft landing. I think most of us would prefer to do that. But then again, maybe some of us would just like to get it over with. Let's get a recession. Let's make it quick. Let's make it nasty for a few months and then bring inflation down and kind of restart the clock again. Of course, the implications for the bond yield, at least initially, are higher bond yields, and for the stock market would be a lower stock market led by downsides in valuation, and then worsened by a downside in earnings. That's not my most likely scenario right now. Right now, I'm still at a 30% probability of a recession, with the likelihood that earnings expectations will continue to rise, and that the valuation multiple will hold pretty close to where it is. I've been thinking that the downside for the forward PE for the S&P 500 is around 16. I think we got pretty close there on Thursday when we had that sell-off on an intraday basis. But I think at the end of the day, we were like at 16.7 for Thursday, and then we rallied up to 17.1 on the forward PE, and we'll see how things play out today. But I try not to be too much of a day trader with my forecast, and my basic view is that the economy is in good shape, consumers are in good shape, businesses are in good shape, banks are in great shape, and we're not likely to get a recession, not out of the realm of possibilities, but we're not likely to get one, and that we'll see some moderation in inflation, enough to have the Fed and the rest of us believe that it is in fact moderating rather than staying persistently high. Again, last week was a marketing week for me. This past weekend was an eventful weekend. My son graduated from Quinnipiac, so I'm glad for that. And then my daughter's boyfriend is on the University of Delaware lacrosse team, and they weren't expected to beat Georgetown, but they beat Georgetown in a real close game. It was a really good game. And now I'm kind of torn because they're in the quarterfinals. They'll be playing Cornell, and as some of you may have noticed, I've got a Cornell cup. But I'm going to be rooting for them for the University of Delaware, despite the fact that I'm an alumnus of Cornell. The other thing I want to mention before we look at the charts is I hope you've been getting and seeing and enjoying our quick takes. Every now and then during the day when I'm inspired to kind of give you a quick take on something that's of note for investors, we put it out as a one sheet with a chart. Let me know what you think of that, and let me know if it's more information than you need, but either way, let me know. Let's go and look at the charts here, and the topic is, let's remove the cover sheet and go straight to the charts. The topic for the week, for the morning briefing, I should say, for Monday's morning briefing, is everybody seems to be waiting for something to break. And what I mean by that is this is the first time I can really recall in the 40 plus years I've been doing it, that everybody's just waiting for something to break. And the Fed has only started to raise interest rates. It did 25 basis points in March and did 50 basis points in May. We're still under 1% on the Fed funds rate for sort of the range of the 75 to 100 basis points on the Fed funds rate. And so the Fed's only started to raise rates, and it's made it pretty clear that they want to increase the Fed funds rate by another 50 basis points at the next meeting. And after that, by another 50 basis points. They want to get to 2% pretty quickly. And then I think they want to get to 2.5%, which is what they've deemed to be the neutral rate, whatever that means. And some of them indicated, if necessary, they'll go above the neutral rate. But as we all know, with the benefit of historical hindsight, Fed tightening policy cycles tend to be at some point abruptly ended when the tightening causes a financial crisis. So as you can see in figure 1, here's the federal funds rate, and then the red and the blue shades show you the red is when the Fed funds rate's going up, the blue is when it's going down. And as you can see, during the red tightening cycles, it takes a while. It's not you don't usually get the financial crisis within one or two tightenings of the federal funds rate, but here we're already getting a lot of anxiety that something's going to break any day now and cause a recession. So that's obviously had an impact on the S&P 500. You can see that there have been plenty of episodes here where the Fed's been raising interest rates, and yet the S&P 500 has continued to move higher. But here, just anticipating that the Fed would be pivoting from dovish to hawkish has already weakened the stock market. And by the way, last year we had a lot of bubbles that started to burst. So whether we're talking about the meme stocks, is it meme or meme? You let me know. The meme stocks, the Robinhood stocks, Kathy Wood stocks, a lot of these, and then the SPACs, all these bubbles started to lose air, if not actually burst. And more recently, we've seen the cyber currencies taken, cryptocurrencies taken. I knew there was something wrong when I said cyber currencies. I mean, cryptocurrencies have taken a bit of a dive, and there's been all kinds of calamities going on in that market just in the past 2 weeks. We know that benefit of hindsight, the SMID caps, the small cap, mid cap stocks, their earnings expectations have been on fire. They're just going straight up, and yet the stocks have either gone sideways last year or down more recently this year, and so their PEs have come down. So the risk off has been clearly conveyed by the SMID caps, maybe not clearly enough for me, because I thought that they've been cheap, and they're continue to get cheaper and cheaper, especially as the analysts continue to raise their earnings expectations. But now the S&P 500 forward PE has kind of caught up to the downside with the SMID caps just in the past few weeks, and certainly so far this year. Let's have a look at that. So here's this is through May 13th through Friday. So as you remember, we had that sell-off on Thursday, and then we had a nice recovery on Friday. But as of Friday anyways, the large caps were down to 17.1, and you can see that this is the correction, possibly turning into a bear market, hopefully not, but it's been a long correction that started basically on January 3rd. So starting at the beginning of the year, we were like around 21, and now we're down to 17. So that's a substantial fall off in the forward PE. Look at the mid caps. Again, I've been thinking all along this way that they look pretty cheap. Well, they got a lot cheaper. And meanwhile, earnings expectations continue to be very, very strong. And so we're down to 12 and a half. Sorry about that. I got a touch screen here. So we're down to 12 and a half on the mid caps and 11.9. I mean, we're kind of in recession territory for some of these valuation multiples. I guess there's more downside possible if we actually get a recession, but if not, I think I'll play the same song I've been playing for a while here. It's SMID caps are amazingly cheap. The large caps have gotten cheaper, led by growth, the growth PE coming down, led by the mega cap 8 coming down a lot. So let me see what we got here. We got this. This is the growth and value. So you can see that the mega cap 8 forward PE is down to 24.3. So it's around here, which again gets you back into the lockdown territory. So that's pretty cheap. I mean, they had a pretty huge run up here as everybody wanted to own them because they were going to be the beneficiaries of the pandemic, and they were, but nothing is forever. In this case, it wasn't for very long. Not too bad actually through 2021. And then so far this year, we've given up a lot on the mega cap valuation multiple. And that in turn, because mega caps account for now about 45% of the market cap of growth, that's obviously had an impact on growth down to 20.5. Value is fair valued, as far as I'm concerned, 14.9. And the S&P is down to 17.1 on Friday. And if you take out the mega caps, you get something more like 16. So again, the market's relatively, it's fairly valued. It's relatively attractive as long as there's no recession, which is my story. So we've looked at the mid caps. Let's not look at that again. Bitcoin. So again, just expectations that the Fed was going to pivot from ultra easy for so many years since 2008 to now tightening, especially having to tighten more because of inflation, has taken a lot of air out of things like Bitcoin. So you can see that chart here. How about housing? There's a lot of concerns that housing is the next bubble to burst. We know that home prices are up 35% over the past 2 years. So I've been pointing that out for a while, but there's a lot less leverage. If you just look at the consumer themselves, there hasn't been that much of an increase in mortgage debt. And meanwhile, there has been a lot of increase in owner's equity. And it could be a case of easy come, easy go, where some of these gains start to come down. Back in Las Vegas, one of the fellows in the audience came up to me afterwards, and we had a chat. Said he was retired, living in Sarasota, Florida, and he said that for our entertainment, he looks at Zillow to see what his house is worth. They said it's been going up double digits for the past 2 years, and then said suddenly the past month it's down 7%. So for all the talk that the Fed's behind the curve, I kind of agree with some Fed officials who recently said we've used forward guidance to tighten, and we've done that by talking up bond yields and talking down valuation multiples. And so I think we've already seen a substantial amount of tightening going on here, which we'll see in this somewhat slower activity. By the way, one of the 5 business surveys just came out for, I guess we're talking about May. So the New York Fed business survey came out, and it was down quite a bit in May, and the prices paid, prices received also were lower, but still remain elevated according to the release I'm looking at right now. So it's basically stagflationary, not much growth in May, and still a fair amount of inflation. Okay, so the consumer's in good shape, businesses are in good shape. You don't have to take my word for it. Just read the morning briefings. We'll be covering that topic. We'll look at it again in a second here, but banks are doing well. The bank lending certainly doesn't look like a recessionary environment so far, though it never looks like a recessionary environment right before you get to a recession in the year-over-year change in bank loans. But you can see they're up $785 billion after this kind of pandemic-related swings. Industrial loans, those are total loans. This is industrial loans at the banks are up. Remember, businesses financed a great deal of their debt in the corporate bond market over the past couple of years. Now, as bond yields are going up, they may be going back to the banks, and maybe some of the junkier credits are finding that it's not so easy to raise money in the capital markets anymore, so they may be going to the banks. And then revolving consumer credit is up. It was up a lot in March. And maybe that's a sign that we got problems with the consumer, but I'm not there. I am watching the yield spread between the junk and the treasuries. That's, I guess, something to worry about. But then again, this was way too low, and we're kind of getting to the right point. But you know, the problem with this spread is by the time it tells you there's a problem, we all know there's a problem. It moves pretty quickly here, yet it's something we need to keep an eye on. So I guess you can start to worry somewhat about this upward trend. Well, we still have this problem with inflation, clearly, and we're still worrying about, everybody seems to still be worrying about a recession. Everybody, I'm worrying about it, but I'm not giving it a high probability, and we'll see how things unfold here, whether I'll fold. But you can see the CPI headline came out, and it was 8.3%, a slight downtick, barely noticeable. Core, a slight downtick, 6.2. We know that consumer durable goods inflation is showing signs of finally peaking. Used car prices, new car prices didn't come down. There's sort of a new way for calculating it to muck things up. But used car prices, I think we're going to see some moderation here in appliances, furniture, and the like. No sign yet of a peak in non-durables, and that may continue to be a problem. As we know, gasoline prices record high, and food prices may continue to be real troublesome going right through the summer. And then services are starting to be troublesome on the rent side, though I'm going to be writing a lot on rents. You know, there aren't that renters aren't everybody. There's a lot of homeowners, and yet we account for rent paid by homeowners as though they're paying themselves rent. It's just really a bizarre concept. And so I think rent is going to be a statistical problem, but I think from a reality perspective, it's really not as widespread a problem. But here you can see the wage growth tracker. Through April shows signs that wage inflation isn't moderating, and there's the CPI rent. So that's the wage and rent component of the wage price rent spiral. And so that's still spiraling to the upside. Though we have pointed out that another measure of wages, average hourly earnings, is in fact showing some signs of moderation when we look at the 3-month. The problem with trying to do it for that wage growth tracker is it's already based on a 3-month, and then it's a year-over-year percent change in a 3-month. So it's not very easy to do what we do for average hourly earnings. Again, not much reason to be hopeful here on the inflation news. When you look at the PPI, we had trade services up 15.4. It's a downtick. Trade services are a bizarre concept, but it kind of makes sense. It's a markup that retailers and wholesalers charge on what they distribute. So it is their markup. And so wholesalers and retailers obviously having no problems marking up their costs at the rate of 15.4%. They might actually be coming out ahead. But of course, one of the things they're marking up here is their cost of transportation and warehousing, and that's just off the charts at 22.6%. There's some evidence in the one survey called CAS that things have started to moderate there. And then, of course, take out these two components and things don't look so bad. They look like they're actually moderating. So maybe if things do slow down in the economy and there's less upward pressure on transportation and warehousing. We know that Amazon has basically announced that they've overbuilt on warehouses and have to cut down some of their capacity. So that's sort of an early indication that whole area may be starting to slow down. And PPI final demand, that's kind of the top line of the PPIs, total goods, services. Not much reason to be hopeful, but these are April numbers. And our scenario is by June, July, we're going to see more definitive signs of all this peaking out. Speaking of recessions, not only people are worrying about inflation, but they're worrying that the only way inflation is going to come down is with the recession, and they're worrying that higher prices are in fact depressing consumers, and consumers are going to cut back. I have no doubt that they're going to cut back on spending on consumer durable goods and other goods because there has been so much pent-up demand that's been satisfied. But I do think services consumption is going to pick up, and clearly there could be some inflation there as well. But this is a unsettling recessionary indicator here. Is the total consumer sentiment index. As you can see, it typically dives right before recession, so that's what it's doing here. So maybe the consumer's about to cut back, we're about to have a consumer recession, which again, some people might view favorably as like, let's get it over with, reset the clock on the financial markets and bring inflation down and so on. This is also one of the contributors to the index of leading economic indicators. And as I've said so before, there's 10 components there. So if you got one going down, but you got meanwhile initial unemployment claims going up to all-time record highs, near record lows, that's an important offset. So that's my monologue. Let's open it up. Oh, I see we got a few questions here. Okay, David says quick takes are good. Thank you, David. Paul, while we realize the Fed's expected policy is priced in, with the reality, quote unquote, priced in and discounted, with the reality of all the liquidity actually coming out of the economy via interest rate hikes and shrinking of the balance sheet have an impact on the stock market. I think it already has had an impact on the stock market. As I said, the Fed's forward guidance has certainly had an impact on tightening up conditions in the capital markets, with 2-year and 10 years yields having done what they've done, and with the forward PEs in the stock market taking a dive, and with a lot of speculative bubbles bursting here. So a lot has been discounted by the market. Everybody's waiting for a capitulation here, and we've had a few days where it looked like a capitulation, and it wasn't. After all, we went still lower. Maybe what we need to be looking for is just exhaustion. The people just, get exhausted of selling, and that they've sold out everything they wanted to sell, and they all of a sudden have gone from kind of short-term traders to having core positions, and then taxes become an issue in terms of selling. So I'm more thinking that we're kind of nearing an exhaustion phase for the market, where it kind of goes sideways rather than continues to take a axe to the valuation multiple. And so far, it's just been valuation multiple, because, as I said, the earnings expectations are still going up. So, I could just be dead wrong here that not only does the valuation multiple go down, but the earnings go down, and then you get lower PEs. So that's something that isn't out of the realm of possibilities. It's something that people are worrying about, and by worrying about it, they've been discounting it. But look, as I've said before, Paul, there's a tremendous amount of liquidity left over from the past 2 years of helicopter money. M2 is still something like $3 trillion over its pre-pandemic trend line, where we would be if you just extrapolated that trend line. Deposits, demand deposit all-time record high. 20% of M2 is in demand deposits, which is the most liquid that measure of liquid assets has been in about 20 years. So there's a tremendous amount of liquidity. Interest rates going up here, but the corporations have refinanced a lot of their debt at record low rates. So that's been my story, but clearly the market's been really more consistent with what you're saying, Paul, which is the perception that when the Fed tightens, that dries up liquidity. Certainly has dried up liquidity and sort of the way the market trades. But in terms of actual liquid assets, there's plenty of them there to keep the economy growing, and obviously also maybe continue to make inflation more persistent, and also to help find a bottom here for the stock market. John, I love the quick takes. Good. I hope you continue them. I certainly will. Anonymous, how does 2022 quantitative tightening compare to 2017, 2019? Anonymous, I'm glad you asked me that question, because that's exactly what I'm writing about for tomorrow. I came up with a clever headline called "Run for the Hills, Runoff." See, so clever, I forgot it. It's not "Run for the Hills," it's "Runoff for the Hills." A lot of nervousness out there that the Fed, starting in June, is going to start to reduce its balance sheet by letting maturing securities roll off. And so I'm addressing that issue. So stay tuned, but some interesting things I'm coming up with. One is that as the Fed is about to stop has stopped its purchases, and now is going to let the stuff mature and run off, the federal deficit has narrowed really pretty dramatically. We're still talking about $1 trillion over the past 12 months, but it's narrowed dramatically. Outlays have obviously come down. We're not getting those checks from the government, the helicopter money. So stimulus programs have finally run into some checks and balances politically. So it looks like the outlays are coming down. And what's really interesting is revenues are absolutely soaring. And so we all know what the downside of inflation is. It's a tax. It's higher interest rates, but it is a tax. And as a result, in nominal terms, the government's revenues are absolutely soaring. And a lot of that is individual income tax receipts. And I guess if people are being forced by the stock market to take the money and run, there's going to be some substantial capital gains here, in portfolios that have to be paid. So very, very interesting. The other thing we'll know at 4 o'clock today is the ticks data. I'm not talking about the Lyme disease ticks. I'm talking about the Treasury's ticks data, Treasury International Capital. And we have data through February. So I'm very, very interested to see what March data is going to show. And it's probably going to show record capital inflows into the US, which would confirm why the dollar is so strong. So sure, the Fed's going to be cutting back on its holdings of treasuries and mortgage-backed securities. But meanwhile, the federal deficit is shrinking pretty dramatically as revenues soar. And on top of all that, we've got probably a continuation of massive capital inflows into the U.S. Because let's face it, the world doesn't look too safe these days, and the U.S. remains a safe haven. Okay, Tim, saw on CBS Sunday Morning yesterday a piece about the lack of employees in tourist areas. A chocolate shop in Falmouth would normally employ 25 employees for the summer season, but only has 5 up to now. The piece mentioned the difficulties with foreign workers getting visas. Yeah, that's a very good question, and it is turning out that one of the issues has been legal immigration has been stymied for one reason or another. And I guess the illegal isn't the kind of workers that employers are right away going to sign up to put in a chocolate shop in Falmouth. But it is what it is. My daughter works in the healthcare industry in Raleigh, and she's telling me that she's seeing signs that it's actually getting easier for them to hire people. That actually she thinks this inflation is kind of forcing people to boost their incomes, and so maybe it's part-time workers or whatever. But I think it's clearly a problem. We have seen wages go up a lot, and when you look at the wage growth tracker, a lot of that's in younger people. Again, my daughter at the University of Delaware got a couple of offers for internships this summer, and I was floored that both of those internships, all the internships, were offering something like $15 to $17 an hour, which is not something internships used to do prior to the pandemic. Before the pandemic, used to pay nothing. So maybe that's somehow impacting the wage numbers. But it is an impact, and it could contribute to slowing in the economy or just making owners work a lot harder. Doug, will the Fed care about the meltdown in crypto, or will they see that as a good thing? And do you think there's a systematic risk from some of the stable coins? I shed no tears over the meltdown in cryptos. I've been arguing for a long time that cryptos make no sense to me. I've been arguing that Bitcoin is either worth $1 million or more or zero. I have no way to value it. It's all a matter of whether there's enough zealots to keep driving it higher. And I think recent action suggests that they're running out of fans. I could be wrong about that. Maybe it's still going to go up to $1 million, but there's no way to value the currency. And then the whole infrastructure with stablecoin has suddenly turned out to be fairly flimsy. I'm sure the Fed also is shedding no tears, has absolutely no concerns. It's just not a big enough market with enough leverage implications. I don't think there's any systematic risk in that market kind of imploding. So that's kind of the way I'm looking at it. I'll take a couple more questions. Let's see. Hans, we are spoiled by a decade of low and stable inflation, and there are many in this market who have never dealt with high and unpredictable inflation. Initially, the reappearance of inflation was explained away as temporary. I got to skip this; it's a long one. I'm sorry. The inflation genie is out of the bottle, and getting it back in will take more time and more pain than we realize. Failure to act quickly and decisively in early 2021 is, yeah. I mean, Hans is kind of going over the the alternative scenario, maybe more realistic than mine right now, more like the 1970s all over again. That 1970s people were shocked by inflation, didn't have much of experience with it, and this time around you also have a lot of inexperienced people, and it could very well persist as it kind of continues to become a wage price rent spiral. That's not my story, but clearly it's a risk. Hans says, are we not at risk of underestimating the Fed's aggressiveness? Well, I think the Fed has made a pretty bold pivot, at least with forward guidance that has had an impact on tightening things. And I think the Fed has made it clear they want to go to 2.5%, might go somewhat above neutral. But having said all that, they've already tightened to the point where the 2 years 2.6%, and the 2 years a pretty good year ahead leading indicator of the Fed funds rate. So the capital markets are already pricing in a Fed funds rate of 2.5% to 3%, in my opinion. Okay, let me see what else we have here. We have a bunch more. but we've run out of time. If you don't mind, one of the things I have an ambition to do with quick takes is that if you do have a question that you think might be worthwhile to highlight in a quick takes, just a couple of quick paragraphs, or in the morning briefing, just email me and we'll address it to you. I've always kind of viewed Yardeni Research as your economics department and your strategy department. So feel free to inspire us and give us some questions along the way. Look, have a great week. Thanks for joining. I'm glad I was able to do this live after recording for the past 2 weeks, and we'll keep it going. And thanks for the positive feedback on quick takes. All the best.